Well, hi there. Welcome back. Um, as we mentioned in the introduction, or as I mentioned in the introduction video, this site's going to be about learning how to trade in stocks, ETFs, and options. At the most basic level, that would be a stock. Most people have heard of stocks. A lot of people don't understand it. They don't know how it works and that sort of thing. At the most basic level, it represents ownership in a company. When you buy a share of a company like Apple or Amazon, you're buying a small piece of that business. If the company grows and becomes more valuable, your shares increase in value. If the company struggles, your shares can lose value. So why stocks go up and down? The price moves based on many factors, really. Company earnings, they have to report their earnings once a quarter, and that can drive the price up or down. And sometimes, like the earnings report can be very good, and then the price will drop. There's just not a lot of reasoning behind it, but that happens. You want to be very careful around that time frame. Anyways, news and expectations. Anytime that there's a news article about a company, you'll notice that the stock tends to be impacted by that market sentiment. Just could be maybe the market's not happy with you right now. For example, there was a time Tesla was just loved by everybody, and then because of things going on in the news and what Elon is doing, it had an impact. Economic conditions. I can tell you the war in Iran has had an impact on the stock values and things, and also supply and demand, which is that's just basic in any market. If if the demand's high and supply is low, the price goes up. That sort of thing. So, how do you make money with stocks? Well, there's really two primary ways: capital appreciation. Most people understand you buy low, you sell high. You can also short a stock, and I'll have a whole different video on that to explain how it works and why it works. But you can actually, if you have your account set up properly, you can short a stock, which means that if it goes down in value, you'll make money. I know it sounds weird, but it works. Another way that you make money off a stock is dividends. A lot of companies pay out a dividend, periodic to the shareholders. Risks of buying stock. You're buying an individual company. If that company fails, so does the value of your stock. Kind of goes without saying, right? Prices can be volatile, and you're exposed to company specific risks. So, the bottom line, stocks are powerful wealth building tools, but they require research and risk management. And again, that'll be the first thing we really kind of focus on. Once you get your mind wrapped around that, the other things just grow from there. What are ETFs? ETF is an exchange traded fund. Some people call it electronic traded fund, call it whatever, but it's an ETF. ETF is essentially a basket of stocks that trade like a single stock. You might go, wait a minute, this sounds familiar. Is this like a mutual fund? Well, there's a big difference between mutual funds and an ETF. And that primary difference with a mutual fund, you can only technically get in and out of a mutual fund after the trading day has closed, because that's when they can sort out how much that mutual fund share is worth at that time. So the downside to that is during the trading day, if the market starts to crash and the value of your mutual fund just starts nosediving, you can't get out of it until the end of the day. That's why you hear these horror stories of people, oh, I lost 30% of my retirement, 401k in the market or whatever. It's because they're in mutual funds. Um, that's the downside to the mutual fund. The upside is also the upside to an ETF. It's diversification. If you buy a mutual fund, that mutual fund owns a collection of stocks and sometimes bonds and things like that. But anyways, it's a collection of securities. Well, an ETF does the same thing. It's based around certain, like categories and things like that. But instead of you having to pick out one company that you think is going to be successful, you're buying a basket of stocks. But the key is that it trades like a single stock, meaning at any time during the day, during the trading day, you can get in it and you can get out of it, and that's very powerful. So instead of buying one company, you're buying a collection. Uh, Popular example of this is what a lot of times you'll hear the term spider, and that's just the SPDR acronym, and that's the S&P 500 ETF Trust. It's traded as SPY. When you look up the ticker, if you want to see what that is, and it tracks the S&P 500, an index of the 500 largest U.S. companies. Now, I'm going to give you this number so it'll make a little more sense in a couple of minutes, but a share of SPY, one share of SPY today, I just looked up the number today, is approximately $655 a share. That's a lot of money for one share, but you're buying a composite, if you would, or a collection of those companies. Uh, so why ETFs exist? ETFs were created to provide diversification. They lower the risk than what you get with an individual stock, and it's simplicity for investors. Instead of guessing which company will win, you invest in the whole market or sector. Types of ETFs: there's index ETFs. They track markets like the S&P 500. You have sector ETFs. They focus on industries such as tech or energy or healthcare. Commodity ETFs. They track things like gold, oil, that sort of thing. There are international ETFs, and this gives you exposure to global markets. A lot of people think any stock out there worldwide is traded on the NASDAQ, and that's not true. There's there's multiple markets, and so like for example, if you're trading the Wall Street as most people know it, market, that's the NASDAQ is what it's called. Now, so how do you make money with ETFs? It's kind of the same as stocks. The price will appreciate or it won't, and so the value goes up and down just like a stock. And some of them also pay dividends. The risk of ETFs, market-wide downturn affects them. Excuse me, I got a yawn going on. Sorry about that. There's less upside than picking a winning stock. So it's still subject to volatility, which is volatility just means it goes up and it goes down, right? So the bottom line, ETFs are ideal for beginners or anyone who wants diversification without complexity. So what are options? An option, and this took me a little while when I first started looking into it. I thought it was like a part of the stock, and it's not. It's a separate security, and it's a contract. So options are where things start to get more advanced and more powerful. An option is a contract that gives you the right, but not the obligation, to buy or sell a stock at a specific price before a certain date. There are two main types, excuse me. There's the call option, and then there's the put option. Now, just so you give you two terms that you'll hear often, bullish and bearish. Uh, think of a bull, right? And he's flipping people up, right? Like you see in the ring there on the movies and stuff. So when a market is bullish, what they mean is that the market's going up. You think of a bearish market as how a bear comes clawing down onto its prey or its victim. So if a market is bearish, it means that it's going down in value. So a call option gives you the right to buy a stock at a fixed price You you buy calls when you believe the stock will go up. Example stock, Apple's trading at 180 a share. You buy a call option with a 185 strike price. If Apple goes to 200, your option increases significantly in value. An option contract controls 100 shares with a fraction of the cost. And to give you an example, you remember earlier I talked about SPY. Well, I also looked up the contract value. Now there's multiple strike prices, so there's multiple values, but in the basic ballpark, you can get a contract on SPY, and it's $4.88 per share. So there's again the contract is for 100 shares, so that contract costs $488. Now these brokerages, they charge fees. So I'm on Schwab myself, and they charge 65 cents plus another penny for something I don't know. But anyways, I just rounded up. So $489. You might think, well, that's a lot of money. Well, it is, but you are controlling 100 shares that normally trade for $655. So that 100 shares is equal to $65,500 and for that 100 shares of SPY. So this gives you a little idea. There's leverage, a lot of leverage built into an option. So as that stock goes up a little bit, so does the value of that contract. If it goes down, same thing, it goes down. So a put option is bearish. A put option gives you the right to sell a stock at a fixed price. You buy puts when you believe a stock will go down. Example stock, Apple's at 180. You buy a put with a strike of 175. If price drops to 160, your put increases in value. I'm reading this stuff. I know this stuff is. I'm just trying to stay on track so I don't go off too many rabbit trails. Why options are so powerful? Options allow you to leverage your capital, control more with less money, and profit in both directions, up or down. You use these advanced strategies for income and hedging. This is why many active traders, include day traders, focus heavily on options. The risk of options, and this is important, options are not just stocks with more speed, they come with unique risks. Things that impact the value of with an option, there's things that impact the value of the option. Time decay. Options lose value as time passes. Volatility impact, as the market changes, so is that. The total loss potential. If an option expires out of the money, it can go to zero. This is why beginners often lose money with options. They underestimate time and volatility. So when you look at stocks versus ETFs versus options, ownership. With stocks, yes, you have ownership. ETFs, you have ownership. With options, you don't have ownership. You have a contract. Risk level, stocks are medium, ETFs are low, and options are high. Complexity is low for stocks, low for ETFs, and high for options. Leverage, there's not leverage in stocks themselves, there's not leverage in ETFs, there are in options. Income potential, for stocks is moderate, for ETFs is moderate, for options it's high, but it's risky. And best for stocks are best for investors and traders. ETFs are best for beginners and passive investors, and options are best for active traders. And when do you use each? When you you use stocks when you believe strongly in a specific company, you want long-term growth, you're okay with some volatility. Use ETFs when you want diversification, you don't want to pick an individual winner, and you prefer to set it and forget it approach. Use options when you want to leverage and fast returns, and you're actively trading. Got to be really careful with the options, though. And you also have to understand you have to understand risk management with options. So real world strategy, there are many successful traders that combine all three. And Depending on the size of your portfolio and what your goals are, you may consider that, or you may start with one and work your way towards the other. The ETFs are great for a core portfolio. Stocks are great for targeted opportunities, and options are tactical trades where you can make some short-term gains. This layered approach provides balance. It gives you stability, growth, and aggressive profit potential. Final truth for most beginners miss: the tool isn't what makes money. You do. A beginner can lose money in ETFs, which is true. A disciplined trader can make money with options. A long-term investor can build wealth slowly with stocks. Success comes down to risk management, discipline, strategy, consistency. And so that gives you a rundown on the basics of stocks, ETFs, and options. So next, what I'll do is we'll start getting into more depth and talk about the stocks, and then sometime after that, we're going to start talking about looking at charts and reading the charts and understanding the various aspects of the chart. Hope you found this useful, and look forward to seeing you soon. Take care. Bye.